Dollar cost averaging, a simple investment strategy with profound performance. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard. Happy New Year, everyone, and it's so great to be back with you to discuss everything gold, silver, platinum, crypto markets, and everything else in between. Back here for 2025, we're starting the year off with an absolute bang today, not only on insights, but also with the introduction of a brand new product called Ainslie Saver. It ties in perfectly with the news article Drew wrote for us today on dollar cost averaging. Welcome back, Drew. Happy New Year. How are you going?
Good, Chris. Happy New Year. Thanks for having me back on. And yeah, that's really exciting with Sabre being launched today. So plenty to discuss.
There certainly is. Now, I thought the best way to approach this, we'll talk through your article, a few things that you highlighted, but probably then tie it back to this idea of Ainslie Saver and what it is and how that would work as well. Because I think I already know people are very excited about that. They've been asking for this for a long time. But let's just start off. In the article, you talked about dollar cost averaging, this concept, probably a good idea to explain what you mean by that. But you say that it's the simplest and most powerful investment strategy there is. So, can you walk us through that core principle? What is dollar cost averaging and why is it so effective?
Yeah, definitely. Dollar cost averaging or DCA is it's pretty commonly used term in investing strategy. And what it essentially means is just making consistent, regular investments into a market that you're confident in, that you understand, that you know what the product is. And you do it regardless of any sort of specific analysis. You're doing it more at a specific time of the month or, when you get your paycheck, more like putting away some savings. You just consistently invest into the market and you do it over a long period of time. Generally, the results on this sort of an investment strategy tend to outperform almost everything else. You hear about people doing really well in certain markets, and you ask them how they've done it, and it's usually something frustratingly simple, like, "Oh, look, I just bought this percentage worth every month for 5 years," and then they're sitting pretty, and they've outperformed people that are trying to time the markets, trying to navigate bull and bear cycles, and there's a whole bunch of reasons why it actually works, but really it's about separating emotion about consistency and discipline. And it's one of those things where you end up really getting the benefit of time in the market rather than timing the market.
Mm.
And it really fosters discipline, consistency, and separation from emotion. So it's incredibly powerful. And if you start crunching some numbers, they really will speak for themselves.
And it is a point that is often missed because I mean we're in the industry. We are constantly talking about time in the market. It's what we talk about in insights all the time. But the thing that's really lost in that, I think, for the average person who's approaching this is that emotional dynamic. And you've touched on that a couple of times there, because the emotional pitfalls are where people really get caught out. They buy in the frenzy. Like we all know you should buy low, sell high, right? That's the idea. That's obviously how you make the most money. But the pitfall is people buy high in the frenzy because they're buying because they feel they're going to miss out, or that FOMO effect, fear of missing out. And they always sell at the low because they have fear the other way, going, oh, well, it could just keep going. So they end up sort of doubly hurting themselves there. Can you maybe talk us through that a little bit? Have you got any examples or just your perspective on it, how it helps you with that discipline?
Absolutely. Look, unfortunately, I've got one too many examples from people that I've seen, personal experience, and your stories that you hear about all the time. But really, from what you find of observing markets for a long period of time is that the most successful investors are not the ones with the most financial literacy, the best analysis, or the most information. It really comes down to certain character traits. The most successful investors are the ones that are the most patient, the most disciplined, and the ones with the most emotional control, the ones that are able to separate themselves from their emotions and make financial decisions based purely on numbers and just have that consistent long-term approach. The markets are sort of this mechanism that move wealth from the impatient to the patient. And I think there's a Warren Buffett saying that, sort of goes along those lines. So the DCA approach is really something that helps you get out of your own way and separate yourself and your feelings from your decisions. Now, the decision to buy something, to vote for someone, any active decision like that, it comes from the same part of the brain that regulates emotions. So when someone's going to make a decision on buying a boat or a car or voting for a president, they're not using facts and logic and numbers. They're actually using emotions about how they feel about this person, how they feel about that car. And investing is no different. When you're deciding when to buy or sell, as much as you can have all the information in front of you, the part of the brain that's actively making that decision is the part that feels the market's really strong or feels the market's really weak, and that's just not the right way to go about it. So dollar cost averaging will solve that problem and just help you take a longer term, disciplined, consistent approach to any asset.
It's so interesting when you put it in that perspective about how the brain actually works when it's making these decisions, because a lot of people wouldn't think that way. They think they're being really data driven. They think they're being really based on facts when that's provably not the case. But you specifically talk about gold and DCAing gold versus bank savings. So people will be familiar with the idea of DCAing in their bank account because they would do it through just saying, well, I put $50 away every fortnight when I get paid, or $100 or whatever it might be. They're used to doing that. But you point out that there's inflation, there's taxes, there's these hidden drains that occur on savings accounts that can potentially be overcome by thinking in precious metals. Can you maybe talk us through that a little bit?
Definitely. So with savings accounts, unfortunately, on a long enough time frame, the interest that you earn in a bank account is always going to be less than the long-term inflation rate on a long-term time frame. I mean, these numbers can move back and forth, but if you have a government that's in incredible amount of debt, and that debt is dollar denominated or whatever the currency is, it's the currency gaining value over the long term makes that debt impossible to service, especially at a high interest rate. So you've got to have lower interest rates and higher inflation on a long time frame for the financial system to continue working, really. So as much as these things move in cycles back and forth, you will see over a long time frame, money in the bank gets eroded by inflation because you might be earning 2.5, 3.5% in the bank, and the inflation rate sitting at 5. So really, your purchasing power is getting weaker every year. In dollar terms, you might be making more, but in terms of wealth and purchasing power, you're actually losing. The other important point on taxation that you mentioned is that whenever you get your interest on a term deposit, it's taxable income for that financial year.
Mm.
Versus for capital growth, it's only when you sell the asset, and if it's a long-term holding, that capital tax goes down even further. So from a tax perspective, when you're trying to compound over a long-term time frame, getting hit with taxes consistently each time you get a return reduces that compounding effect in a way that's really understated. More often than not, people don't really pay too much attention to that side of things. So again, once you crunch the numbers, it's quite convincing. And the issue with having it in a bank in the long term is all sorts of other risks like counterparty risk,
Mm.
management risk, operational risk versus investing in an asset like gold or a hard asset. Not only are you getting a higher return on investment, but it's actually less risky. Even though most people think that the least risky option is a bank deposit, really investing in a hard asset like gold to me is much less risky than that.
And I just want to dig into that slightly more because this point about getting hit with those taxes every time. So, just to understand what you're saying, you're effectively saying that when you receive that interest for the year, you then would pay tax on that interest, for example. But when you are just holding an ounce of gold, well, you're just holding an ounce of gold. So there is no event until you actually go to sell that. So you might be making the gain, but there's sort of the gain's been held in the asset itself. So is that what you're talking about there when you say the ability to really compound that up, is that you can hold those gains in that form over a long period of time and you can sort of choose effectively when you take that gain or not?
Spot on. Like if gold is giving you an average return of about 10.5% a year over the long term, you get 10% and you get 10% the next year on that 110%. Versus with a bank savings, you get, let's say, 3.5% per year. And then the next year, it's not 3.5% on 103.5% because you've lost a little bit of that 3.5 profit
Right.
on the taxes that you've paid on that. So the compounding reduces year after year. And inflation is even more of a issue in this scenario because
Mm.
it really is a hidden form of tax where your money is, losing value every year because the government is increasing the money supply so that they have more spending money. It's really to fund the government is where inflation comes from. So if you're looking at an inflation of 7 to 8 to 9%, gold will keep pace and outperform that. And then that way, if you're looking at, for example, buying a house, if you have your money in a savings deposit, you're losing your buying power for that house year after year after year. There's a hole in that bucket. If you look at what a home costs in Australia in ounces of gold 50 years ago versus today, it's pretty much the same. Versus if you look at what it was in terms of Australian dollars, even if you had that in your savings deposit and you were earning interest on it, you're at a huge loss and a massive disadvantage if you were doing that over the long term. So it's really fighting inflation and taxes.
And yeah, no one would argue that a house costs the same as it does that many years ago today. That's for sure. You can certainly see it in that example, how that plays out, particularly that inflation angle over a long period of time, and that compounding angle. Probably the last question before I ask you some more specifics on the Ainslie Saver product is just common misconceptions or pitfalls that, from your experience, you've seen people have when they think about dollar cost averaging. Is there some ways they can avoid falling into those traps, really around the emotion, I suppose?
Yeah, definitely. I think, quite often people will say I'm going to dollar cost average, but then they still keep looking at the market saying I'll average in more this month and I'll average in less this month based on what the market's doing. It sort of defeats the purpose. So with the dollar cost average strategy, it really is about separating yourself completely from even watching too many of the specifics. You're
Yeah.
investing in an asset that you're confident about. So that's another pitfall where you just got to make sure that you're investing in the right asset as well. Dollar cost averaging into the wrong assets just simply not going to work. So
Mm.
you pick an asset that is fundamentally strong, has performed well over decades and centuries, and you know it's the kind of asset where you don't actually need to pay attention to the market. You can just invest in it, switch off from it, look at it 20 to 30, 40 years later, and you know you're going to be fine because it's proven itself.
Mm.
And then actually switch off. Don't adjust it. Don't lose your plan based on your emotions and just stick to your plan as it goes on.
So that might be, you might be looking at it once a month or even once a quarter, not looking
If
at it
that.
every day.
If that, it's sort of like, you buy a house, you don't check the value of the house every month even. These long-term strategies, you might look at it even once a quarter or once every 6 months. And it's something that actually it it makes you wealthier in the sense that you now have more time, and time is a form of wealth as well. So rather than having your mental space and your time occupied by looking at this sort of stuff, you're suddenly freed up to spend more time with your family or work or your hobbies, and that in itself is a form of wealth. So you're suddenly freed up and you're time wealthy and you're time rich, and you know that you set yourself up for long-term success, and you can simply just switch off from it at that point.
So obvious segue here into the Ainslie Saver product. It's something people have been asking for a long time, really to address everything you've talked about today, this idea of dollar cost averaging, making it really simple. Can you give us the 30-second, 1 minute overview? What is Ainslie Saver and how people can get involved with that?
Ainslie Saver is a dollar cost average based saving mechanism where rather than saving in Australian dollars in a bank account, earning very tiny amounts of interest, you're saving directly in gold and silver, where you get to take advantage of the capital growth of gold and silver over the long term. You get consistent purchases every month where you can set up an auto payment from your bank account directly. And you can choose your ratio between gold and silver as well, which I think is a really handy tool. So anyone following the gold to silver ratio, as
My
the
favorite thing for
ratio
us to talk about.
yeah, that's right. As that, the ratio is sitting at 88, 89 at the moment. As that ratio moves, you can just adjust your asset allocation ratio between gold and silver as to how much you want to buy. So it makes investing in the market really easy. It makes managing your gold to silver ratio really easy. And it switches off that emotional side of things of, oh, is it going up? Should I buy more? Is it going down? What should I do? You just have a weekly or a monthly or whatever period that you want to set payment set up with Ainslie, and you've got your gold and silver stacking up month after month, and then you get to take advantage of those compounding returns on investment. And if anyone wants to read the article, we actually got a table there that shows some numbers where if you were to invest in gold over 5, 10, 20, 30, 40 years with certain amounts, what it would come back to. And compounding really is an absolute wonder. People don't think wrap their heads around how powerful compound investing is. It's something that really just builds exponentially, and exponential growth is again something it's difficult for us to wrap our heads around because we think in a linear way. So, really have a look at the article, look at those numbers. Ainslie Saver is something that will help facilitate that for you in the long term. And it makes selling really easy as well. Anytime you want to sell, it's just a phone call and an email away, and you can have that money back into your bank account. And that helps you with your liquidity as and when you need. You don't need to be lugging around physical metals. You've got that sort of flexibility. So, like you said, it's something that's been a long time coming. We're really excited to release it today, and we've been having a lot of customers ringing up. So, if anyone's got any questions, they can always give us a bell.
That's wonderful. And just probably my last question on that, it is really straightforward, isn't it? What's the best way for people if they're interested and want to check that out? Do they just go onto the website? What would you recommend?
100%. Go to ainsleyBullion.com.au, click on Ainslie Saver and set it up. It's a couple of steps. It's like setting up a Facebook account or something. You know, you've got to do a little bit of an ID verification step as well if you haven't done that already. And it's not complicated at all. So I'd highly recommend people go on the website, check it out. We've got a nice video up there to guide you through as well.
That's wonderful. Look, what a start to the year. It was a really fascinating discussion, anyway, on dollar cost averaging. And to be able to back that up with a product that allows people to do that a little bit more easy is just a wonderful way to start the year. So thank you very much for your time and effort on that. I'm sure people will be looking forward to it and checking that Ainsley Saver out. So thanks, Drew.
Thanks, Chris. Thanks for having me on.
Thanks, everyone, for watching. Looking forward to this year. It's going to be a good one. We'll chat again soon.